Hi there, welcome to Kneppy Invest. Time for another Kneppy's analysis video. And in today's video, we're going to be looking and focusing on a company called Tehcnology One, which might be argued, some would argue with me that this is one of the highest quality companies on the ASX, if not the highest quality company. I probably would argue differently. I'd also classify Tehcnology One as a cult stock on the ASX. A lot of fund managers absolutely love this company, and for good reason. But because of this cult-like status, the multiples you do have to pay for this company, or a premium you have to pay for this company, are quite high. So in today's video, we're just going to go through their financial results, look at the quality of the company, what they do, look at the charts, those sort of things. For full disclosure purposes, I'm not a shareholder of Tehcnology One, although this is a company in my high quality companies that I want watch list. Tehcnology One is one of those companies in that list. So if I ever see a significant pullback in the share price, and on occasion we do see pretty good pullbacks, I might take position in this company. Right now, it is overvalued, in my opinion. So a strategy you could do if you really wanted to own this company is to nibble at it right now. And if the share price does pull back, you add to your position. Now, averaging down may not be a good strategy for most investors, particularly if they use that strategy for bad quality or low quality companies. But for a company like Tehcnology One, I think it's very wise to take advantage when the share price does dip. So what exactly does Tehcnology One do? So to understand what this company does, I think it's also a good thing to understand what ERP is. And this is from Investopedia. So ERP stands for Enterprise Resource Planning. So I'll just provide you with the definition from Investopedia, a process used by companies to manage and integrate the important parts of their business, often via software, which is very important, to connect planning, purchasing, inventory, sales, marketing, finance, human resources, and more. So it seems like any sort of ERP software would be highly valued by any sort of business. And that is definitely true because there is a lot of competition in the ERP software space. So Tehcnology One is, well, they call themselves a leading global SaaS ERP solution company. The current CEO of Tehcnology One is Edward Chung, and interestingly enough, on the 15th of August, it was announced that he is also now the managing director of Tehcnology One. So obviously the board think quite highly of Mr. Chung. Now, a really good thing about Mr. Chung, Edward Chung, he's been in Tehcnology One for quite a few years. I'm thinking about 15 to 20 years because he was appointed as a CEO in May 2017 after spending more than 10 years in senior executive roles at Tehcnology One, including the company's chief operations officer. And it also says here from 2014, Edward Chung headed up Tehcnology One's products and solutions division, including research and development, where he led the team that transitioned the business into a fully SaaS-based organization. So I would say that Edward Chung knows everything about Tehcnology One, and he's the ideal person to be in the CEO role and managing director role for this company. Now onto the quality of the company, and it should be no surprise that I would classify Tehcnology One as a high quality company on the ASX. I've already hinted at that in this video, but when you do look at some of the metrics I look at in determining whether a company is high quality or low quality, there are some metrics here that might make me rethink about my classification of this business, particularly when it comes to revenue growth. So what I do is I look at the last 10 years, 5 years, and 3 years of revenue per share growth. And typically I want to see revenue per share growing at more than 10% per year. But for Tehcnology One, over the past 10 years, revenue per share has only grown at 7.4%. Over the last 5 years, 4.4%. And over the last 3 years, 8.4%. But there could be an argument revenue growth is starting to accelerate over the past few years. Return on invested capital is at 20.7, and that is where I want to sit. However, in my notes for this company, I did say that the company has seen decreasing return on invested capital over the past 10 years from the high 40s to 20, and that is a little bit concerning. particularly if that continues over the next 5 to 10 years. You don't want to see return on invested capital decreasing much more than below 20. EV to EBIT, which is sort of like a valuation metric, pretty high at 39.1. But I'll talk about more valuation around Technology One later in the video. Total returns over the past 10 years, 24.6. So you want to see 24.6% return per year for any company you own in your portfolio. Now, I did mention here, though revenue growth, underwhelming, expanding net and operating margins means that has led, those increasing margins, has led to a 13% or greater than 13% increase in earnings per share per year. So even though revenue growth is below 10%, earnings per share growth has been greater than 10% because of increasing or expanding margins. But increasing, expanding margins can only go up so much. You want to see revenue growth get a little bit higher than 10% to see earnings per share growth being maintained above 13% per year. So overall, this is a high quality company. A few slight red flags there, but I believe that revenue growth of say 8.4% per year over the last 3 years, if they can increase that to above 10%, I have no qualms calling Technology One a high quality company. Now, a few facts in regards to Technology One, and these are facts from the July 23rd. This is when I actually produced the slide deck for this particular video. So we're talking about 1.5 months ago. And the whole reason why it's taken me this long to do a video on Technology One is simply because August is really busy because it's results season. And even July was pretty busy because that is Appendix 4C month as well. So this company was founded in 1987 by Adrian DeMarco, listed on the ASX in 1999. So it's been around for a while. The major shareholder, or one of the major shareholders, is John McTaggart. He has a 7.7% owning in the company. Share price on the 23rd of July was $15.33. Now, I was going to change it, but the share price on Friday, the 1st of September, was $15.55. So not much has changed in share price over the past month and a half. Company has 324.7 million shares on issue, which means the markup of this company is $5 billion. So keep that in the back of your mind, that the valuation of this company in terms of markup is $5 billion when we look at the financial performance of this company. So now on to the financial performance, and this is the trailing 12 months. The last financial report we did see from Technology One was their half-year results in May. So they will report their full-year results in November. So again, markup of this company is $5 billion. Revenue in $397.2 million. Profit $96.9 million. So straight away, valuation, markup, $5 billion, profit is less than $100 million, which means P/E ratio of this company is greater than 50. Operating cash flow, $151.9 million. Free cash flow, $77.3 million. Operating margins, 28.8%. And equity, $253.5 million. So if you look at the return on equity, pretty high return on equity, in fact. So we are talking about 436, 40% return on equity. That's a nice return on equity. And that's the sort of thing most investors who are looking for high quality companies will focus on, those sort of return on equities. Now, some interesting things I found in the half-year results. So in this particular slide, we're looking at where they get the revenue from in terms of SaaS fees versus annual license fees and consulting services. So this company is transitioning to a fully SaaS company instead of annual licenses. And you can see the increase in SaaS fees went up from 96 million to 145 million, while annual license fees dropped from 39 million to 21.3 million, while consulting services revenue was flat at about 33 to 34 million dollars. And I probably should have mentioned that those revenue numbers in the previous slide were half-year numbers, not trailing 12 months. Now, one thing I do like to see is the disaggregation of revenue or profit by division and also geographic region. And in this particular slide, the company has dissected their profit into different divisions, software, consulting, and corporate, and also their profit by region. So we can see where they do derive most of their revenue from, or what region. Now, most of this company's profit is through their software, and that's being driven by strong SaaS growth. In fact, $37.2 million of their profit, so that's more than half, through software, $5 million through consulting, $10.5 million through corporate. Didn't know really understand what corporate was, corporate profit. It does say here that corporate profit, which was up 69% due to increased royalties generated by strong product sales. Now on to the geographic breakdown of their profit. So overall company profit, $52.7 million, $49.7 million of their profit was through Asia and Pacific. I'll probably say majority of that profit was in Australia, $3 million of profit in UK. So this company is not truly global in my opinion. Even though they do say they're a leading global SaaS ERP solution company, they're not really global. So there is potential, even though this space is highly competitive, there is potential that this company can keep on growing, particularly if they do expand overseas. But this company is profitable in the UK, profitable in Australia and Pacific. Another thing I like to see is a breakdown of a company's revenue by sector, if you can do that. And Tehcnology One has done that. They've broken down their revenue by sector. And by far, the majority of this company's revenue comes through local government and government. I think this is ARR, but the majority of annual recurring revenue is through local government, 124.3 million, and government, which might be federal government, state government, which is 51.5 million. Also education, 89.4 million, health and something else, 35.5 million, asset and project intensive, 29.4 million, and financial services and corporate, 20.5 million. Now, the interesting thing about local government, federal government, state government, education, you would think those sort of areas are quite sticky. They don't want to change the software they are using. That might be true for other sectors, but I think that is particularly true for local government, federal government, state government, also the education sector. Something else that is very important is customer churn. If you see fairly high customer churn, that probably means that the software or the service the company is providing is not that beneficial to a business. So this company has a 99%, maybe even greater than 99% customer retention over the past 10 years. In fact, there are some years this company has a customer retention of 99.6%. Financial year 2013 and financial year 2017. Does seem like the churn was a little bit greater in financial year 23. That is a forecast, but it does mention here that is expected as a result of end of on-premise temporary high churn of EOOP is 0.3%. Not sure what that is, but if you do look at financial year 21 and take away this EOOP, which would put that down to 1.3%, this company has seen a little bit higher customer churn over the past 3 years. Now to some of the financial history of the company. First thing here is total revenues, gross margins, and cash flow from operations. So the first thing I always look at when I'm researching a company is revenue growth. And this is just what you want to see in a high quality company, revenue growth each and every year. There was 1 year where it did dip. That was in 2018. Not sure why that was. Maybe it was a transition from annual license fees to SaaS. Maybe, I don't know. Haven't done that much of a in-depth research on the company, but revenue has more than doubled over the past 10 years from $180 million to $368 million. More importantly, gross margins are starting to increase. Well, not starting, they've increased quite considerably over the past 5 years. Now, between 2013 and 2017, margins were right on 38%. And then they dipped back in 2018 to 32.7%, 8%. So I do think possibly that was a year where they were making that transition, and that could explain the decrease in revenue, also decrease in gross margins. And then all of a sudden, gross margins started to increase, which is another reasoning behind me thinking that that was a year they made that transition from annual licensing to SaaS, because gross margins have increased from that 32% all the way up to about 55%. And we also have seen cash flow from operations increase each and every year. In fact, cash flow from operations have increased fourfold over the past 10 years. Another way to determine whether a company is low quality or high quality is just look at the dividend history. That's all you have to do. Look at the dividend history. And this is what you usually see in a high quality company. Dividend increasing from year to year to year. Now, dividend yield is fairly low, 1%, but you're not buying Tehcnology One for their dividend. In fact, what you're buying Tehcnology One is for their growth and if the company can keep on growing over the next 10 years, based off your initial capital invested in this company, the dividend yield on that initial capital will be significantly higher than 1%. In fact, it'd probably be 10%, 20%, maybe even 50 or 100%. And that would be significantly higher than any sort of dividend for the banks or Telstra or Woolworths. That's the reason you invest in these companies and maintain a position in these companies for the long term. Not only do you get the capital growth, you also get significant dividend growth. Now to the valuation, and the one thing, the only thing that should be holding anyone back from taking a position in this company is valuation. And because this is a highly thought of company, because it is a cult stock on the ASX, you do have to pay a premium if you want to take a position in this company right now. PE ratio 51.4, price to sales ratio 12.6, price to operating cash flow 32.8. Also did a reverse DCF based off the earnings per share. And to justify the current valuation of this company, the earnings per share would have to grow at 25.9% per year. When I say to justify, I probably should clarify this. That means I want a return of at least 10% per year. So to get that 10% per year, I need to see, or I expect to see, earnings per share growing at 25.9% per year. I think this company might struggle to get that over the next 10 years. One of the keys to investing is to find those companies that will eventually become cult stocks on the ASX, because when they make that transition from becoming a non-cult stock to a cult stock, you will see significant multiple expansion of that company. More than likely, you'll see multiple expansion. You also see financial expansion, and that's where you get significant share price appreciation. So in this particular slide, we're looking at the PE ratio history of Tehcnology One from 2003 to 2023. Now, more than likely, back in 2003, 2004, not many fund managers probably heard of this company. It was probably ignored company on the ASX, and the PE ratio of Tehcnology One back then was around or under 20. In fact, during the GFC, the PE ratio of Tehcnology One fell to almost 10. Yes, you could have bought this company with a PE ratio of 10. And then, to be fair with you, between 2009 and 2012, the PE ratio of this company remained below 17.5. So back then, this was not a cult stock on the ASX. And then things started to turn around in 2012. And the PE ratio of this company went from 15 back at the start of 2012 all the way to a high of 55 in 2016. So it took 4 years for this company to transition from a non-cult stock to a cult stock. And ever since 2016, this company has been a cult stock on the ASX. Now, the PE ratio did fall to 30 back in 2018. That was a really good time to take a position in this company, but there was a little bit of fear. You remember this company was making that transition from annual licenses to SaaS. Remember there was that drop in revenue, drop in gross margins. That was a period of time where we did see the PE ratio of this company fall to below 20 or below 30. And actually, yeah, below 30 for a very brief period of time. And the PE ratio has been as high as 60. So in terms of the historical range of PE ratio for this company, 55 or 52, what it is now, is actually near the top of that range. So I would not classify Tehcnology One as a cheap company right now, just based off their PE ratio. But in saying all that, when you look at the weekly chart for Tehcnology One, going back to 2013, start of 2013, this is the chart you would see for a high quality company. Share price has been in an uptrend since 2013. In fact, it's been an uptrend since 2011, 2012. That was that short period of weakness. In fact, I would say a 2-year period of weakness in the share price from 2016 to 2018, where the share price actually went sideways and down a little bit, and that was during that transition period. But since then, since the start of 2018 or midway through 2018, share price has been in a beautiful uptrend. On occasion, you will see the share price make a little bit of a dip towards the 150-week moving average, which is that solid blue line. We have seen it occur about 4 or 5 times in the past 3 years, but the share price is well above that area right now. So that blue line is right on $12. So if I saw the share price of this company get down to, say, $12 or even $11, I would take a position in this company. I've had a little bit of a break doing these Kneppy analysis videos, but I'll be doing more and more of these videos over the next few months because we are in a quieter period on the stock market. So I do plan to do way more of these videos in the future. And the next 5 companies I'll be looking at or focusing on in this video series are Dusk, Perseus, Macquarie Technology Group, Universal Store, and WH Soul Pattinson or Washington H. Soul Pattinson. If you do have any suggestions of companies you'd like me to feature in this series, and I want those companies to be profitable, revenue generating, I don't want any sort of story stocks at all, leave your suggestion in the comment section of this video, and I'll see what I'm able to do. That is all I have for this video featuring Tehcnology One. If you have any thoughts about this company, if you want to be shareholder of this company, I'd love to hear your opinions, your thoughts. So leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is certified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.